Ladies and gentlemen of the crypto space, we're live on a Friday, July 29th at 11:26 a.m. You know by now we think a little bit different. We think actually quite different as compared to the majority, as compared to the narratives we hear in the crypto space and social media and YouTube and all that stuff. So we're going to look at data today. Well, wrong data sets, wrong narratives. We're going to look at data. We're going to see the right data sets or the better data sets. We're going to look at data sets that help us look at really what markets are doing, not what people think they're doing, and we're going to try and invalidate some narratives, which is exactly what we've done since the beginning of the stream. We've defined new narratives, which inherently invalidates narratives that we don't think are reasonable. We think our narratives are increasingly reasonable, and no doubt we come to the point where we've seen empirically that our narratives are much more sustainable. Now, we'll try and bridge the gap between the prevailing narrative and what we talk about to help maybe new persons that hear our stream. And the prevailing narrative is Bitcoin. I buy Bitcoin. Bitcoin is a store of value. It is an inflation hedge. Now, obviously, it's not an inflation hedge because inflation is hot and the asset's price has gone down significantly. Now, this is a chart presentation of the time-weighted average price on the monthly. And this is much more of a truth or appearing through the madness as compared to looking at price action, which is seeing the irrationality of the average market actor involved with it. This is just completely irrational. It doesn't make any sense. There's no peering through the madness. There's no seeing what it really is. And it'll drive you absolutely mad trying to interact with this kind of price action volatility. Like yesterday, I posted, you don't buy yesterday. That's not when you buy. And obviously, if you look at curve, you had a nice dip. You got a good 10% dip down. A buck 40 compared to a buck 58. So why buy yesterday? You know it's going to come down after a massive rally like yesterday, so you wait. So we have to do things differently, and one of the most obvious ways to do things differently is to look at a completely different data set. How do you allocate capital looking at price action, which is the bars that you see on the chart here? Damn near impossible. So what I do is I like to turn off the price and I look at the average price over time. Now, if this is a debasement hedge, that makes perfect sense. Especially if you're looking at the average price, we're getting less and less depreciation over time. And since this is the average price on the monthly, what's happening is we're having the volatility, large depreciation, but it will take time for this average price to go down. As you can see, this is a very pronounced top and slope down. This is much shallower, and this is obviously very shallow. If you look at the red, you'll see that the red is the longest here back in 2014, 2015. It's shorter here, and it's shortest here with the more pronounced peak and likely trough to come. So I would say this most closely aligns with the rate cycles, and we'll see what happens. There's so many macroeconomists that expect prolonged hiking. Even considering yesterday why the market rallied, that there was lack of forward guidance or lack of suggestion that rate hikes would continue to increase. If we see zero point 0.5 or 0.25, that's equivalent to dishiking. It's like disinflation. It's less of a hike, so that would be likely construed as loosening in many regards. At least that's exactly what happened yesterday. So this is a very interesting chart. Now, I don't have really any interest at all at owning Bitcoin, at least for the prevailing narrative that you buy Bitcoin, you hodl it, it goes up over time. Yeah, that's going to take a long time, especially at these prices of 24,000 or whatever it's at. How long is it going to take to get a 10x on your money? And that narrative is completely dead for small persons. Like $1,000, $1,000 turns into $10,000. That doesn't change anything. You realize if you buy $1,000 worth of Bitcoin and it goes to $240,000 of Bitcoin, you made 10 grand. It does nothing. And 240 grand Bitcoin, the world is changing. If you see that price point, that changes everything. That's a crazy price point. Something significantly changed for that to occur. And you only got 10 grand out of it? Yeah. The Bitcoin will not, cannot mathematically do what people think it's going to do. And especially, it cannot protect against inflation. It cannot protect against debasement. Why? Because people don't understand you have to capture the volatility. Now, if you bought at 24,000 and it goes to $240,000, it doesn't mean shit because you didn't do anything with it because it'll go back down, it goes back up, it goes back down. What does it mean to do something with it? You need to spend it. And if it goes to 240, that's when you spend it at the 240. You don't spend it at the 24. You don't spend it at the 50 or the 100. So that means if you're holding Bitcoin, you can only spend it at opportunistic periods of time when it's at its exuberant price point, which means it's not very useful. It's not practical. So, my goal and interest really of late is to invalidate that narrative that it's a good asset for small actors. Now, obviously, I'm biased from a U.S.-centric standpoint, but even then, I think USDC is much more meaningful from a hyperinflationary sovereign nation standpoint. If you're not capturing the volatility on Bitcoin, I think it's silly. And it's such a high price point to get a 10x on it. It's not the volatile asset that I would be interested in capturing, or it's not lucrative. There's so many other increasingly lucrative assets that you could take risk and get 100x. Now that changes things. So I like this chart because it peers through the madness. It gives us a presentation that's not the average, it's not the consensus, it's not the majority. And that's why I like it. I don't like it because I'm trying to understand the price point for an entry. I'm going to buy it. I'm going to sell it. I'm going to try and extract capital gains and capture the volatility. But I find it very interesting that the trend for the last many years, 8 years since 2014, since the depreciative cycle at the middle end of 2014, was shorter and shorter depreciative cycles with increased volatility even on the average price. Very interesting. I just posted a tweet that is really the narrative that I hone in on. It's enterprise over store of value. And it's more than that. It's because enterprise is a store of value. Owning a business is the storing of value, except the difference is you don't have to sell the business. So that's what I really think is the greatest opportunity in the space. And because I think that is the strongest narrative, that invalidates the other narratives. Now, let me answer some questions, but I want to try and tie it in with the prevailing way people interact with markets. Capital gains, buy low, sell high, technical analysis. And that's important because you need to have a fair amount of money in order to buy enough of an enterprise to get enough cash flow for it to be meaningful. So I will never discredit or discount that strategy or that approach to having assets on your books. It's always important to be able to get outsized gains so you could grow the amount of capital you have so you could buy a meaningful position in a cash flow enterprise. But that's something I haven't talked about a lot over the last year and a half. It's never the best technical trader. I understand the technicals, but it just doesn't fancy me anymore, especially. Clearly, my technicals have improved, but I still choose not to engage in that type of market activity. Now, I often say I want to make less money. So a good reason I say that is because it's the hard thing to say. It's a sacrifice. I see plenty of technical opportunities, but I don't take them because what is that? That's So the righteous thing to do is to not take other people's money. Because just remember, capital gains is the taking of other people's money. It's the concentration of wealth from many to few. So anyway, I hope that was a decent story. Not the clearest as always, but maybe it's useful. Joe, perfectly rational. You are a rational person in this irrational market. It's a very irrational market. But it's getting more rational, at least from the social media interactions that I see. I have very rational interactions. I have such a wonderful rational community, even on Twitter, which is obviously notorious for having a very diversified set of persons that offer so many opinions, and it's just pretty consistent. Actually, remarkably consistent. The interactions in tweet replies. Very little contention. Very few people really have offer counter arguments or critical opinion to what I say, reinforces the rationality that we try and convey. Yesterday, there was two comments that were quite interesting. Folks were like, "How wrecked are you?" Because I said yesterday you don't buy, and that just really shows the relative newness of that person to the space. Not that they're new in the sense that they're just getting a taste of my presentation and the story that I tell, but they're new in literally just interacting with capital markets. You don't buy when the market's green. You don't. You buy when the market's blood red and it's crushed, and you never think it's going to come back, and you don't think it's a bottom, and you think it's going to go down, and that's the risk. You know, you don't take a risk when everyone just bought and it's just ripped to the upside 30%. I mean, the market's up 200%. Curve's up 200% in the last month, and now everyone's like, "Oh, it's a good time to buy a curve." In a market with this macro backdrop, oh, that's not a day to buy, guys. And what was the other comment? The other comment was, "Oh, yeah, just sit on the sidelines," and or something like that. And it was definitely a statement from a person that just saw the markets rallying, and they're like, "Oh, you don't sit on the sidelines. The market's starting up. Everything's getting bullish again. That's not when you buy. You buy when everyone thinks the market's dead. You got to be late 2019 or December 2020, and everyone is getting it's the bearish sentiment meter, and it's the counter trade. That's the bottom line. And that's really the story that we started with today. Everyone looks at the wrong data sets and they look at the wrong narratives, and you got to look at the opposite of what most people look at. Dan's in the house, Zoidberg, Gazika, Raul, Crypto Bets, Morning Cap. Look, I took the plunge into Convex at $6, selecting bribes. Will open August 3rd. What's the date window that is needed to be done by? New to the vote locking, don't slap me. So you go over to Vodium, and it tells you right here, you need to have Convex locked by August 3rd. That's it. The date window by August 3rd. And then you'll see a bunch of bribes here, and you can always go over to the Llama Air Force, llama.air force, and you can see the history of them. These things are paying. I mean, Frax is still paying millions of dollars a week, or at least $1 million a week, give or take. That's big numbers. And the options here will link you to Snapshot. Snapshot. I don't have any snapshots available. That's the curve page, and you'll be able to select a specific incentivized vote offering, rather than doing this delegation. I don't do this delegation shit. I like to pick what I want to vote for. For instance, I voted for two-pool Frax, not necessarily because it was the most lucrative, but because it's an important thing to direct liquidity to. It's an important component of the stablecoin market in the crypto space going forward. It's these meta pools. This is actually really good to see that there's at least some capital allocated to increasing LP deposit incentives. And it happened quick. This is just a couple weeks. I think it launched like 2 weeks ago, maybe 3 weeks ago. And this liquidity is going to be attracted to it. So this should change over time the landscape of liquidity availability throughout the crypto space, and that's a good thing to see. It's a good direction to see things heading in. Vince, synthetics has been awesome. So synthetics is old school. Synthetics started my entire experience in the crypto space. Late 2019, I got bought at 70 cents, and I played till like $7, and this thing ripped up way high. It was in 30, 20 something, $28 in February of 21. So where was I? September. No, here. Even earlier. I bought even earlier. It's not even on the chart. This is the Binance chart. So I have a high opinion of synthetics from a history standpoint. So it has a great degree of survivability. Um, I'm not going to digress too much into my opinions on synthetics. Yeah, everyone has to do their own due diligence, but it's quite the productive asset. Some people will be critical over who's doing the trading that's generating the transaction fees, but the bottom line, as a primitive, as a stablecoin, you need SNX to manifest or to collateralize SUSD, and you need SUSD to trade in synthetic markets, Quanta, so on and so forth. And this is all just starting on optimism. Last year, 1 year ago, there was nothing on optimism. Optimism did not have any market penetration. There was no capital, there was no bridges, there was no nothing. So optimism is late to the party. It reminds me of when Phantom had nothing. Curve was the first to deploy on Phantom, and it was multi-chain.xyz that had absolutely no liquidity, and it wasn't there. There was nothing there. So it takes time for these markets to attract and accumulate liquidity, and that seems to be happening for Optimism. It's quite expected. It's an Ethereum L2, so that's meaningful as compared to the Alt L1s. So there's good things and regarding synthetics, and Kane is old school. He created a lot of the stuff that the entire crypto space is based on. And that I'm not overweight synthetics. This is nowhere. This is a relatively small position. As food for thought, the way I've weighted it in the portfolio, very productive though. We could take a peek at how productive it is. I have optimism selected. 101%. Not bad. 2 weeks, $1,600. Is that three and change $1,000 a month? Certainly not going to complain. Um, Kingsley tuned in from work. It's a good break from work, I'd imagine. Oh, work. Rupert, what's up? Coramonti, do you have any interest in insurance protocols? Not really. Insurance was somewhat of an interesting thing back in 2021 because of the complete insecurity of 2020, and there was a great deal of risk. It's all smart contract risk. Insurance really needs to evolve away from smart contract risk as the contracts become increasingly predictable and reliable and trustworthy. As boilerplate code gets better and better over time, and the insurance will be more so traditional insurance, insurance against failure, liquidation, default, so on and so forth. I just don't have much interest in that market currently. Joe, BTC AVAX on Trader Joe, BTC Phantom on Spooky, close to 20%. Double volatile asset exposure. You have exposure to Bitcoin and AVAX, Bitcoin and Phantom, and that's something that I historically don't like. I don't really want to. I don't want to own those assets. I don't want exposure to those assets. But what do I want? I want the trading fees from persons that are speculating on exposure to those assets. So, if anything, what interested me is like Joe, like an S Joe type position. Um, But the burden there is Avalanche is. I like Avalanche. I have a high opinion of it. Um, is the volatility. So it's just something that I don't have exposure to. You can't own everything you want to own. But that would be the type of position that interests me way more than a BTC AVEX position, more like an Estro type position. Have you looked into Umami's USDC vault? Yeah, that's hot stuff. That's cool. So obviously it's quite experimental. It just launched, just sucked in $1 million worth of liquidity in like 15 minutes. So that's cool. Something I have up. Maybe I don't have it up anymore, but I saw what was going on. Definitely quite interesting. Jaeger, very tempting to get in today. Now the macro backdrop is still completely collapsing. So what we have is a contradictory market that's expressing appreciative directionality, which is very consistent with bear market rallies. So I have no expectation whatsoever that we have continued appreciated price action, continued bullishness, continued prices going up. I have no expectation of that, which plays into my introduction to the stream today. It's what does that mean? If it's going to go down, why wouldn't I sell? Because I want the damn transaction fees on the way down. It goes down, transaction fees, it goes up, transaction fees, and I win both ways because those transaction fees go to cash and those cash go to a debit card and that debit card pays for things. Um, that's it. Now, obviously, that's a very big simplification because you need a relatively large portfolio to generate a meaningful amount of income. I'll never discount that. And then the question becomes, how do you make the capital? And you can play markets. You can work. Oh, God forbid we work. Now I know we're all here, and everyone's like, "Oh, Noah's a dick for saying people got to work to make money." But I mean, literally, that's the way we all started when we were 16 and got our first job. You work, you make money, you save money. Except now we're learning how you really save money, and that's the story I tell. You don't save money in dollars. You don't save money in fucking Bitcoin. You save money in business. You own businesses. You own cash flow. You own things that pay you. Which, Warren Buffett always said that owning stock is owning a company. So there you go. There's owning a business. So if we were in the 70s, I'd be an old school dividend investor. Except the crypto space is a burgeoning, exploratory market of newfound wealth and opportunity. So this shit actually pays. I would never get the returns that I get in crypto in the equities markets. So this is the place to be. This is the only opportunity I really see. Anyway, so I digress. Joe, man, these sidelines suck though. Yeah, you should have been in Buffett style. You buy when people are afraid, there's blood, things are crashing, and you scoop things up on a discount. What do you scoop up at a discount? Shit that has survivability attributes. Stuff that has expressed the likelihood that it's going to continue to exist. Cash flow positive enterprise. And of cash flow positive in the crypto space, it's few and far between, especially cash flow positive protocols that pay you dividends. I mean, Uniswap is obviously very cash flow positive, but it fucks over all Uniswap holders. Uni is basically a completely useless token. But might as well be a damn security if it wasn't an airdrop. So, well, but security in the sense of a capital raise, not a security in the sense that it actually pays dividends. So, yeah, I don't have an easy answer with regard to sidelines. The biggest or the strongest, the most prominent rule of thumb that I follow is that when shit that pays is cheap, you're buying something that pays you for a discount. And that's very consistent with the way Buffett talks. Mr. Nobody, hi Cap, pleasure. Raul, personally, I'm also DCAing Bitcoin besides Curve, CVX, FXS in case the whole flywheel implodes. Plus, I can use my BTC on Aave and borrow stables. The DCA and Curve and others, just my 2 cents. Yeah, we've all done that before. And that's diversification. You're covering your bases just in case one particular strategy fails. And we've done all the whole collateralization thing, and man, I wish I sold some more stuff in December of 2021. Because when you have Bitcoin and Aave and collateralizable assets, it's all liquid, so you could just sell that shit. And I didn't extract enough capital from the top. Not disappointed for where the portfolio is. We always could have done better. But yeah, I'm not a fan of that anymore. We played that heavily on Matic when Polygon, when Matic started getting hot, and that was an interesting time. What was that? Early 2021. That was very interesting. Um, but the narrative has changed to where it is. It's too much work, too much effort. You gotta keep a close eye on your health factor. But Aave now has that nice notification system. That's cool to see. Um, and it's all of it's volatile assets. So everything's moving. The principal is moving. The yield is moving in price. The debt is moving in price. And it's leverage. So there's risk on the table of liquidation if you don't manage it. And clearly you could reduce your degree of risk by significantly over collateralizing, but there's work involved. So maybe you outperform the person deploying the sustainable portfolio or the passive portfolio. I just can't get away from the satisfaction of the passive portfolio in that I really don't need to do anything. I could leave my damn portfolio, come back next week, press a claim button, throw the claim on a debit card, and that's it. Now, if I want to outperform the market, what do I want to do? I want to take my certain amount of cash savings, my stable coins, it's not all on a debit card, that make no sense, and maybe I buy something. So that's how I would outperform the market. But right now, there's no discounts. There's nothing I could buy that's cheap. Everything has appreciated significantly. Bottoming patterns with breakouts, albeit this hit the 200 EMA on the daily. So there's plenty of indications for running out of steam. If you look at the 4 hour, is it? Or the 1 hour? Now, looks good on the 1 hour. Curve looks good on the 4 hour. It's the daily. It's the daily 200 SMA. We need to see the 50 SMA with the 200 SMA cross, and we're a long way from there. And curve will be at $2 and probably 25 cents, $2.50 by the time the 200 EMA tries to cross it. So we're not in bullish territory yet, especially from a macro backdrop standpoint. You can easily see a rejection off the 200 EMA, and this forms a much larger structure, a larger bear wedge. And now we have contrarian breakouts where a bear flag breaks to the upside, and that would obviously coincide with some sort of macroeconomic directionality. For instance, the dollar. You know, the dollar, if you look at it on the monthly, it's very interesting. This is a massive, massive shooting star. We've never seen a shooting star. Even back here in '85, there wasn't a shooting star like this. This is a very, very large shooting star. And that was massive candles. Jeez, look at the size of those candles. Multi-dollar monthly candle. Wow. So we're not out of the woods yet. We hit resistance. The candle closes in 7 hours, but if you look back on the weekly, you're still above the TWAB as well as the 10 SMA. Definitely not out of the woods yet, but you start to see a breakdown below the TWAP on the weekly. Let's go back to the monthly. Start to see a breakdown of the TWAP on the weekly. You start to have an increased likelihood of pushing towards the monthly TWAP, which would be at 97. If we see the break of the TWAP of the DXY on the weekly from 104 and change, and we start to move towards 97 TWAP on the monthly, that'll be a heck of a leg in the crypto markets. I don't care how bearish the macro backdrop is, because we have a very clear historic precedence of bearish DXY, which is technically bullish euros mostly, or having a very strong inverse correlation to the entire crypto markets. This was the entire bull run in 16 and 17, is the depreciation of the dollar versus the euro. And it's the same thing in 2020. I mean, It's obvious. It's like right here. Look at the time frames that we had in the crypto markets versus this bearish leg down for the DXY. So once you start to see a topping pattern like this, that's exactly why we're seeing appreciative pressures in the crypto space. We see a leg down towards the monthly TWAP, 96, 97, could be very, very interesting next couple months. With interest rate hikes, no less. Interest rate hikes, the dollar comes down, that would be wild. One curious views in the house, a pleasure. Sheesh. After your bull case on Aura, I decided to invest 25% of my portfolio in this pizza shop. Let's take a look at Aura. I've very much wanted to increase my position size. It's at 318. My initial position size was significantly less, 66 cents. I could go over to the 1 hour. Maybe you could see it. Draw. I don't know. I was in at 66 cents. And I don't want to buy at $3. I'm biased because of the original position size. And it's wildly productive. I think I claimed like 750 bucks last 2 week bi-weekly claim for Aura returns. So that's what, 350 bucks off a $6,000 investment a week. Oh, that was a wonderful entry. But I don't see discounts, so I can't buy it. I can't justify buying at these prices. I would need to see some sort of capitulation now, which should be expected. I mean, obviously, there's wonderful sentiment regarding the asset, but sentiment only goes so far. There's very large Aura yields, which means at some point someone's going to want to capitalize, and all you need is a big whale to trigger a depreciative cascade. Won't necessarily be leveraged liquidations, but a rip to 250 off a a $1-2 million sale. It's going to impact the sentiment of the market. And then you print the lower low, and then it causes other people to capitulate, and then I'll get my discount at $1. I'd love to see $1. I'd probably buy a relatively nice sized position at $1. Less than $1, I'd buy even more. So that's basically where my mind is regarding an asset like Aura. I'm very happy with the position size I have right now, but if I could get a discount, I'm going to buy more. Curve, I would buy as well. I would need to see 60 to 80 cents. 60 to 80 cents, a higher low, and I'd take another clip. That's about it. Nothing going to get added to synthetics. I might actually liquidate convex. It's just not enough for what I wanted to do. I wouldn't say I'm liquidating at all because the narrative isn't validated in any regard. It was just from a portfolio organization standpoint. It's an additional asset, whereas I could concentrate the capital in another asset that's equally productive, that hits the same narratives, and now I've simplified the portfolio. Increased concentration tends to increase outperformance of a portfolio. Diversification is more protective in case shit hits the fan, but there's so many things that are exposed to the curve narrative, you don't have to have multiple things exposed to the curve narrative. Hope that helps. Send it to 100. Yeah, first stop 100 and then a little bit lower. I would, at least that's the way the technicals are set up. FM, Pulse Chain, and PulseX will outperform everything in the next 2 years. Yeah, but they're so boring. There's nothing interesting about that stuff, my friend. I'll be very happy for people that make money. And what is making money? It means you're taking money from other people. It's just, there's nothing interesting about that ecosystem. I'm sorry. There's so many other interesting things going on, but just another chain, it's just boring. Sorry. I feel like that meme when the cartoon dog has the fire, this is fine. Yeah, that's exactly what's going on from a macroeconomic backdrop. And it's not an understatement. Everything is catastrophic from a macro standpoint. But it doesn't mean you can't have outperformance in volatile assets. That's just what it is. And that's okay. And you capitalize because this is Darwin. And it's the survival of the fittest. It's the survival of the person that has the strongest narrative. It's the survival of the person that sees an opportunity that someone else doesn't see. And that's okay. Dan, I'm still hesitant to add to LPs on Aura. I'd rather just lock more. What's your take on the LPs? Tempted. I've been tempted for, um, was it a Aura Bow position? This is balancer exposure. Um, been tempted, but Bow I would need to see a depreciative leg. I already have a V Bow position. It's not as high as I'd like, but I need to see a depreciative leg. I need to see like $4. I would increase the size of the position at about $4. You don't buy at a premium. You either get your price point or you don't buy, and that's how you play this game, and that's how you be very, very, very picky, 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 picky. Quick to sell, picky to buy. Mr. Nobody, do you still see the cross-chain swap the biggest narrative for this year? Yeah, but it's getting be a crowded trade. There's a lot of cross-chain protocols. Uh, Biggest narrative? No, I don't see a single biggest narrative. I see plenty of biggest narratives. Cross-chain automated liquidity provisioning. So that narrative is going to come back in Q4, Q1 2023. Maybe a little later, but that narrative will reemerge. And seamless cross-chain is really, that's hot, but there's no way to really capitalize on it. If Stargate starts, or Layer Zero starts distributing cash flow, that would be very interesting. It would change my calculations, but as of right now, I don't see anything that's interesting to purchase. What's your biggest edge on this market? That the macro is going to turn around. We had a buying opportunity about a month ago. There's nothing to buy right now. I think Curve is a great representation of the state of the market because of how liquid it is, how much sell pressure there is. So the fact that this doesn't go straight frickin' down is one of the biggest things that attracts me to the Curve price. But the Curve buy was at 60, 70, 80 cents. It's not now. It's not when it's approaching the 200 SMA on the daily. Now's a wait. There's a premium. It's up 200%. So the biggest edge is that there's more likelihood than less that we see a higher low, that we see a capitulation, the markets drop, Bitcoin does another leg down, a higher low. Excuse me, a wick. Let's look at the daily. I need the moving averages. You see maybe a wick down, breach at the, nope, on the weekly. So there's the 200 SMA on the weekly, the holy 200 SMA on the weekly. You see a wick down, 20,600. Higher low. That would look wonderful. And this will drag down the rest of the market. You'll get buying opportunities left and right. And at a distance, the biggest edge that I have in the market is that if there's a discount, I buy. If there's no discount, all right. We've already bought. We had a discount, so we bought already. We should have bought already. But that buying is not right now. There's no discounts right now. It seems like the momentum shifted to Ethereum ecosystem heavily. If you think about it, the momentum was always the Ethereum ecosystem, especially in 16 and 17 with ICOs. The narrative now is transaction fees. I think Bankless was talking about this shit as well. And that's obvious. It's what we talk about is owning enterprise, owning access to disintermediated cash flow. That is the biggest narrative. That is the momentum shift. It's owning enterprise that pays you so you don't have to sell shit. And there's always going to be people that are speculating on capital gains, and I just want a piece of that. I'm glad I'm not alone questioning the gains being made in this market. It looks like a lot of us did not position well for this. Yeah, because you bought yesterday and it's depreciating today. And people buy for the wrong reason. They buy because other people buy, and that's the last reason to buy. You want to buy cash flow positive stuff at a discount. You got to follow the macro. There's a reason why it's up, but nothing's at a discount right now. That's probably the biggest edge. There's nothing at a discount right now. Everything has appreciated significantly over the last month. Dan, what's the value prop of choosing BAL exposure over more Aura? Well, 100% APR to start. This is BAL exposure, and this thing's projected to crank out a little over 100% APR. That's big stuff. And BAL is base layer. Ah, back to the curve narrative. Instead of owning a derivative, BAL would be base layer. So that'd be the value prop in my eyes. Koji, is locking CVX only way to earn yield? Any liquid staking pools? Yeah, Badger. Badger's liquid. But the problem there is, why do you want it liquid? So you can sell it? So there's a bit of a complexity there with regard to how to construct a portfolio. Is it a purchase? Is it a position? Is it liquidatable? So that's something to dig into and better understand how you're constructing things. Dan, in my opinion, the narrative for now is real yield based on what popped up the most recently. Well, that gives you something to look at, something as a point of reference, something to assess how successful or how sustainable and overall the survivability of a particular protocol. Is it productive? Is it producing a meaningful yield? Is it growing? Is the enterprise expanding? All these are attributes to assess how well a protocol, an enterprise is doing relative to others. Hope that helps, guys. 21 people on the stream. We're very light today. The market is obviously not exuberant, and that is what it is. You'll see what happens when the markets get exuberant and everyone comes out seeing the high green candles, and that's when you want to own the cash flow, because then it's people that don't understand these narratives and they're just buying anything that's not nailed down. It might take some time, but it'll come. It's inevitable. Human beings are predictable. Friday, July 29th at 12:08 p.m. I thank you all for joining me. As always, please tell everyone to subscribe. We can help one person at a time because we can do better. After party on Discord for the most rational community in the entire crypto space. Love all you guys in there. Appreciate everyone. I'll see you there soon. I wish you all a wonderful weekend. I will see you on Monday.